Here are some more investment insights, building on the wisdom of seasoned investors and fresh perspectives. 1. Understand reinvestment opportunities. Invest in companies with great opportunities to reinvest profits at high returns. Nick Sleep. 2. Use scenario analysis. Prepare for multiple outcomes instead of predicting a single future. Howard Marks. 3. Seek hidden compounding engines. Look for overlooked companies quietly compounding earnings over time. Terry Smith. 4. Bet on industry leaders in tough times. During downturns, market leaders often emerge stronger. Charlie Munger. 5. Emphasize scalability. Invest in businesses with low incremental costs that can scale massively. Peter Thiel. 6. Pay attention to intangibles companies with strong intellectual property, brand equity, and customer loyalty often outperform. Warren Buffett. 7. Factor in population growth regions with growing populations and urbanization trends, create long-term opportunities. John Templeton. 8. Stay close to real trends, not hype. Differentiate between speculative bubbles and genuine trends like AI or renewables. Cathie Wood. 9. Use relative valuation techniques. Compare companies within the same industry to spot undervalued opportunities. Joel Greenblatt. 10. Monitor regulatory tailwinds and risks. Industries with favorable regulation can grow faster, while adverse rules can stifle growth. Ray Dalio. 11. Watch buybacks. Carefully, stock buybacks are great if done at undervalued prices, not just to boost EPS artificially. Warren Buffett. 12. Look for inefficient markets. Smaller markets or niche sectors often provide opportunities due to less analyst coverage. Seth Klarman. 13. Understand the supply chain. Companies with control over their supply chain are more resilient in crises. Jeff Bezos. 14. Watch for management hubris. Overconfident leadership can lead to reckless decisions, even in great companies. Jim Collins. 15. Learn from small failures. Small setbacks can provide valuable lessons without catastrophic losses. Nassim Taleb. 16. Focus on execution, not just vision. A great idea is worthless without the ability to execute. Mark Andreessen. 17. Watch for structural cost. Advantages. Companies with low-cost production or distribution can outlast competitors. Michael Porter. 18. Invest in mission-driven companies. Companies with strong missions often attract loyal employees and customers. Patagonia's model. 19. Watch cross-industry trends. Innovations in one sector often spill over into others, e.g., AI impacting healthcare. Reid Hoffman. 20. Avoid over-reliance on historical data. Markets evolve. Past performance doesn't guarantee future results. Howard Marks. 21. Focus on businesses with recurrent revenue subscription models or high repeat business. Ensure more predictable cash flows. Toby Lutka. 22. Study cost structures. Companies with flexible cost bases can weather downturns better. Bill Ackman. 23. Be aware of technological obsolescence. Avoid companies at risk of becoming irrelevant due to disruptive innovation. Clayton Christensen. 24. Hunt for consolidation opportunities. Industries with fragmented players often consolidate, boosting profitability. Wilbur Ross. 25. Understand behavioral economics. Use knowledge of biases and irrational behavior to your advantage. Daniel Kahneman. 26. Invest in data-driven companies. Firms that leverage data effectively are better positioned for future growth. Satya Nadella. 27. Stay alert for transformative events. Spin-offs, mergers, and special situations often create unique opportunities. Joel Greenblatt. 28. Look for high insider ownership. Management with skin in the game often makes decisions aligned with shareholders. Peter Lynch. 29. Focus on supply and demand dynamics. Understand how scarcity and abundance affect pricing power. Stanley Druckenmiller. 30. Evaluate ecosystem strength companies that create an ecosystem around their products, e.g., Apple, generate lasting value. Steve Jobs. 31. Seek companies with network resilience firms that can adapt and strengthen their networks in crises survive longer. Reid Hoffman. 32. Balance growth and profitability. Growth at any cost is unsustainable. Look for disciplined growth strategies. Mark Benioff. 33. Watch debt refinancing risks. Companies dependent on frequent refinancing are vulnerable in rising interest rate environments. Howard Marks. 34. Use the power of aggregation. Aggregators in media, commerce, or services often outperform traditional competitors. Ben Thompson. 35. Be ready for nonlinear change. Paradigm shifts can render traditional metrics irrelevant. Stay adaptable. Ray Kurzweil. 36. Understand customer retention metrics. High customer retention often translates into stable and growing cash flows. Pat Dorsey. 37. Factor in competitive intensity. Some industries are structurally more competitive and yield lower returns. Michael Porter. 38. Bet on visionary leaders. Leaders with a clear, bold vision often build transformative companies. Elon Musk. 39. Learn from diverse fields. Insights from psychology, sociology, and history can enrich investment decisions. Charlie Munger. 40. Stay grounded in first principles. Break down problems to fundamental truths rather than relying on assumptions. Elon Musk. These insights offer a blend of practical and innovative perspectives, helping investors navigate dynamic markets effectively.